Good morning and welcome to PAC's program, Three Legends and a Recession, a conversation on navigating the COVID recession when those who have been there before. We are excited to present this program to you this morning and are very grateful to Fairmount Partners, a founding leader of PAC, for their support and sponsorship. Three Legends and a Recession. The connection to our Enterprise Awards is on purpose, and this morning you're going to hear from three of our legends. But first, a little bit of a word to our Enterprise Awards program. It was scheduled for early May. We obviously postponed it, and we are going to produce it virtually on September 9th. There'll be communication coming out in the near future to share that date and the specifics. We'll celebrate a dozen of our top entrepreneurs in the region. Perhaps some of those people are participating here this morning. In terms of etiquette for this morning's webinar, attendees are muted and off camera. We have enabled the chat function for general comments or to communicate with the hosts. Please use the Q&A window for any questions. Again, the webinar is being recorded and we can share it with participants, and you can share it out to others. Let me start by introducing our moderator this morning, PAC board member and director of Fairmount Partners, Alan Bourne. Alan, welcome.
Thanks, Gene. Appreciate it. And thanks for joining us, everyone. So prior to COVID, we had seen a period of 11 straight years of economic growth. And because of that long period of expansion, many of today's business leaders have limited experience in managing the minefields of recession. So today it's my pleasure to welcome three business leaders, each winners of the PAC Legend Lifetime Achievement Award, who have successfully managed through prior recessions. So today we're going to talk a bit about past recessions and the lessons learned, as well as the current COVID recessions and what challenges and opportunities might lie ahead. So let me first introduce the panelists. Bob Keith is founder and managing partner of Nouveau Capital and TL Ventures, which raised more than $1.5 billion over 7 funds. Roseanne Rosenthal is president and CEO of Ben Franklin Technology Partners of Southeastern Pennsylvania, which has invested more than $200 million and launched more than 2,000 companies. And Howard Ross is a partner with LLR Partners, a private equity firm that has raised more than $3.5 billion across 5 funds. So welcome, everybody. Yeah. So let's start off with a little bit of historical perspective. So we've obviously been here before. Recessions are nothing new. In fact, we've been through 11 of them since 1945. And today we're going to talk about a couple in particular, the Dotcom Bubble and the Great Recession. And this one we'll get to in a little bit, although I will note, I don't know if you can see my pointer here, that based on GDP forecast for Q2, the GDP will be somewhere way down here. So we'll get to this one later. So to the dot-com bubble, it lasted 8 months, which was pretty short compared to other recessions. Peak unemployment hit about 6.3%, and GDP declined by 0.3%. It was driven by a collapse of technology stocks, a fall in business investment, and 9/11. The Great Recession, which many more of us remember, lasted from December 2007 through June 2009. Peak unemployment hit 10% and GDP declined by 5.1%. It was driven by a collapse of the housing bubble and a collapse of many of the US's largest banks, as well as the auto industry. So that's a little bit of background. So to kick off our discussion, Bob, Roseanne, Howard, it would be great to understand where you all were during these prior recessions and what your roles were.
So I can kick off, Alan. I was, for both of those recessions, I was in my current position as president and CEO of Ben Franklin. And our challenge was twofold, because as a mission-driven organization, we have to balance our work to continue to execute that mission, which is to advance the economy of our region through technology growth, while we're also managing the sustainability of our own organization. Also, in times of recession, as an economic development organization, our work is always to step into that breach. But we have to do that in a way that ensures the continuity of our organization while we're executing our mission.
Great. Howard and Bob?
You know, in the dot-com bubble, I mean, LLR was 2 years old, so we were trying to figure out what the hell we were doing. And we were never really focused on the internet type of company. We were much later stage, you know, more rounded or more bricks and mortar type businesses. So the dot-com bubble didn't really impact us too much. I mean, it slowed the economy down, so we were not as active as we normally are. The Great Recession, though, was a much bigger impact. And I'm sure we'll talk about it some more, but in both recessions until now, I've been working at LLR making investments. I will say that during the Great Recession, our level of investment activity was incredibly muted. We did one investment in 20 months, so you can get a sense of the impact there. But that's what I was doing.
So from my standpoint, the dot-com bubble was had a big impact because we were early stage investors, and I would say in hindsight, one of the mistakes we made through that period was deciding that we should we should stay with early stage investing, and that's why I cringe to hear Howard talk about the fact that they weren't doing internet deals. We continued to do early stage deals, obviously not so much internet. And frankly, we were spoiled by the success of Internet Capital, which was a screaming success, even in West Coast terms. We made a huge amount of money in that short period of time. And one of the other things that happened, just as an aside, and maybe of interest to some of you, is that it brought on the beginning of the, I won't say collapse of Safeguard, but Safeguard had been run by Pete Musser, who'd done a huge amount for this region from a standpoint of entrepreneurs. And Pete had put all of his eggs in the internet basket. And on top of that, he'd borrowed a lot of money personally. All this is public knowledge, so I'm not telling any secrets. And you know that, so Safeguard never really recovered from all of that, which is a loss for all of us, quite frankly.
Great. From my perspective, during the dot-com bubble, I was a young associate investment banker just out of MBA school, and I'm glad I graduated in 2000 as opposed to 2001. I can tell you that. And then in 2007, I was, I think, a vice president, and had a tremendous 2007 and had an outstanding 2008, all teed up. Unfortunately for me, it was Q4 loaded, so to see all those deals go away was brutal. But at any rate,
hey, Alan, just one other quick comment about the dot-com bubble. And Howard and many of the people on the phone and Roseanne will remember this, but there used to be a group of investment banking firms like Montgomery Securities, Robbie Stevens, or whatever, and they would take these very relatively small but promising early stage tech companies public. And after the dot-com bubble, they basically disappeared, which was a real loss as far as I'm concerned, because even though the deals were speculative, it gave the public a chance to get into these deals and frankly some liquidity. So that was a big impact as far as I'm concerned.
Yeah, those are some great names, Bob, from the past. I remember those names well. You also could add H&Q, Hambrecht and Quist, and
Exactly.
Brown.
Yep, those are great
Those
names.
four firms were, and I would idolize those firms when I was in my prior career at Arthur Anderson.
Well, you know, from Ben Franklin's perspective, going into the dot-com bubble burst, since we're talking about that, we were in a good position because we had just come off of our most successful year vis-a-vis returns, because as a result of the euphoric environment that was going on then, a number of our IT companies were being acquired, we were being paid off. So we went into the bubble burst in a very good position, actually. There had been a lot of chatter and signs that, you know, speculation of when was this bubble going to burst. So we took our money off the table early, and it affected 1/3 of our portfolio. So we have a very diverse portfolio, not just IT. So as a result of it being 1/3 of our portfolio and a lot of those companies having retired their investment with Ben Franklin, it didn't impact us as much as the subsequent recession certainly did.
Interesting. So when you think about these two in particular, the dot-com bubble and the Great Recession, how would you characterize them, and how are they different from an operational and economic impact?
Yeah.
Go ahead, Roseanne.
Well, for us, as I mentioned, the dot-com bubble was shorter. Some of our companies certainly didn't make it, but others were doing well because they were acquired and raised dollars earlier. The Great Recession was a lot more severe. It was sudden. There hadn't been the same sort of indicators that everybody had been talking about. It affected the financial industry, so it really cut across all sectors and all of our companies. And because our success rises and falls really with the success of our companies, clearly we had to plan for a drop in revenue. And at the same time, the funding we received from the Commonwealth was virtually cut in half overnight. So we had to, as companies did, we had to redefine our revenue model. Our board under Bob Keith at that time and our staff really rallied, cut our expenses to the bone, prioritized our resources to support. We had almost 200 companies in our portfolio. So our priority had to be to support those companies because none of us had a clue as to how long this was going to last. We also set out to work with our partners across the state, including PACT, over the years then to bring alternatives to the Commonwealth so that we could attract more dollars to early stage investment. The dollars were not going to come from state budget. We also paid attention to what was going on at the federal level and worked with partners to develop an energy strategy that was then very current and brought over 130 million to the region. And then, we started to develop other co-investment partnerships to attract private capital to where it wouldn't naturally go. It impacted our companies across all industry sectors because there was a greater anxiety regarding the timing of how long this was going to last and the structure. You saw federal intervention to save certain industries in a highly charged election year. And then you saw ultimately, broad federal stimulus package for shovel-ready projects that were anything but shovel-ready, and then the resultant increase in government regulation of the financial industry that had a lot of unanticipated consequences in later years.
I mean, both events attempted to wring excesses out of the market. And I think that's what happens with these recessions. The bubble gets a little too thin and it bursts. The beauty of the internet or the dot-com bubble is that it was a more limited in focus, I think, and it seemed to go quicker in my mind. Maybe it's just because of what we were doing had less of an impact. I mean, the Great Recession has the word great in front of it because it was a big friggin' deal, and it was broader, it was deeper. There was a lot of focus on liquidity and leverage, and a lot of that wasn't as relevant perhaps in the dot-com world. But in the Great Recession world, there was a tremendous amount of financial impact, and financially engineered businesses got into trouble. So, I mean, maybe closer, we're going to talk about COVID, but COVID may be a lot closer to the Great Recession than the dot-com thing. Go ahead. Bob will be more elucidating.
No, but I think that's a great distinction. But because I think, as both Howard and Roseanne have said, that Great Recession was, when you think about, Lehman Brothers failing, banks, needing, very, very significant bailouts and so on. So liquidity in the marketplace was really an issue for small companies. And so those of us in the investing business had to be prepared with cash reserves to back our companies or not back them, and make some pretty hard choices along the way, which I think this has always been as a matter of choices. It's fascinating to me today that liquidity, at least in the world that I live in now, which is smaller than the one I used to live in, that getting access to funds, to some extent banks, although certainly more cautious than they were, but getting funding for companies is just, it hasn't declined very much. So if you have an interesting opportunity, I have a small company I invested in very early stage that just 2 weeks ago got a $3 million investment from a Boston VC firm. and they did it all through Zoom. They never met personally. And so I'm sure a lot of that's happening. And of course, the public markets are continue to be strong, and the IPO market's good.
Right. Thinking back to those days, Bob, you mentioned that you were having to make tough decisions about, do I support, do I not support? So how are you thinking about those decisions? And Howard, you and Roseanne as well. How are you thinking about those decisions? And what were some of the operational or strategic mistakes or challenges that you saw being made in the face of these recessions?
Well, I think it's a matter of, very candidly, experience. So some of these business models began to fall away under their own weight, meaning that the prospects for continued success and growth became fairly apparent. So one had to pick and choose among those. And that was, that's just where the experience came in. And I would say, in my case, in our case, we were, not great at that. We were not as good as maybe we should have been, because we had expanded the firm. We had a lot of people around, and so I think being disciplined in these kinds of environments and really looking very, very hard at what's going on either inside your own business or if you're investing in terms of the companies, and being skeptical about who's as Andy Grove said, only the paranoid survive.
Yeah, I mean, some of the operational issues, first of all, we tended to support every company because we were probably making fewer bets than Bob was making and Roseanne was making. And we didn't really want anything to fail. And that's one of the big problems or unsolvable questions in our world is, when do you just say no more money? Because you always have the money. Is when you say no to some company and management team you've supported. And it becomes very much, there's a human connection there that's hard to sever and just say no to. And we debate every week, including in the last couple of weeks. I think looking at preserving liquidity and preserving optionality is critical. And you got to do what you got to do to create the liquidity and look at headcount and look at non-essential expenses. And those lessons haven't changed. And, one lesson that I've seen over and over again is you never cut deep enough. That's a hard thing to say, but we tend to think it's always going to get better tomorrow. And it often doesn't.
I think
That's
from our
interesting.
perspective, another thing that sort of error that we saw some of our companies making in both cases was sort of unwillingness to take the dollars that were being offered on the table in anticipation that there was a better valuation out there somewhere. In one case, they didn't realize the party was ending. In the other case, they didn't realize how long the distress was going to be lasting. So that was an error that some made. I think as folks have said, it really comes down to leadership, as we had to take a look through and do a triage of a lot of companies in our portfolio. Who were the CEOs that were able to make those hard decisions and had the strength and to really critically assess what was important to the company's survival and what wasn't, as opposed to being enamored with their original vision. I think being able to change that vision to reposition the company and capture what was possible to capture, and what was going to be happening at the end of whenever it was going to be ending, recognizing that their past assumptions were just that. They were past assumptions and really weren't relevant to going forward. And then, those who were able to retain their key talent and were able to explore partnerships that help them to maintain or expand their offerings at the same time they were conserving resources, in addition to making the cuts that were necessary. Those were signs to us that we had good teams.
That's a great point, and you're moving into something that I wanted to get to next, which is what were the key factors that distinguished the companies that emerged stronger as opposed to those that didn't make it? And so what were the success factors of those that were able to retrench and get out of the recession both .com and the Great Recession stronger?
Well, Roseanne hit on the key topic. I mean, where you have strong managers who really understand their team and their business, you know, those are bets always worth making. I think where you have recurring revenue streams, some predictability to future revenue, some visibility on future revenue, those tend to be bets you want to hang in with. A lot of it, and we're seeing this in COVID now too, a lot of it is industry specific. I mean, if you're in healthcare, and I think in technology, those tend to be better bets than a lot of other bets that are out there. So I think it's, and whether or not the company's truly offering something that's unique to the marketplace. The extent it's something differentiated, maybe has carved out a leadership in a particular niche within a market, good management and recurring revenues, that's a brew for a good support.
I think Roseanne made a really great point earlier here, which is the managers that have the experience and or the wisdom to take the money when it's offered. That is absolutely critical. I'm seeing that, you know, even today where, you know, some of the managers are, and some of them are thinking, I can wait this out, or I want a valuation that's, you know, was higher than my last round. All those kinds of things that happen, particularly with overly optimistic or really brand new CEOs, and it's an incredible mistake in my estimation, and because they were spoiled, in my view, by this I won't get on the soapbox, but this annual recurring revenue valuation model, which I used to run around the office here over the last several months, ranting and raving about, you know, what a ridiculous model that is. It's a game of musical chairs as far as I'm concerned. So, you know, my adage is, even back in the banking business, was take the money and run.
As my partner, Ira Lubert, said, or I like to say about Ira, and Bob will appreciate this more than anybody, Ira has made a fortune selling early.
Right.
That's your point, Bob.
Absolutely.
Yeah.
Absolutely.
Made a fortune selling early. Yep.
Interesting. Okay, cool. That's really helpful and great background. So let's turn to the recession that we're living today. And before we get into it, it would be really helpful to understand the concerns and challenges being faced by those in attendance. So we're going to run a quick poll. So Danielle, can you change screens for us? All right. So we have an app called Menti, and what you're able to do with this is to go to menti.com, use the code that's up here, 170821, and just enter your thoughts. What do you think are going to be the biggest challenges for your organization in the next year? And then when we start to get into the discussion and into the Q&A, we'll be able to go back and bring up your thoughts and bring up your comments. And so, again, menti.com, and there's the code, 170821, and we'll come back to that in a little bit. All right, so I am going to, Danielle, can you give me control again? Awesome. Okay. All right, great. Hopefully that worked. All right, so just a bit of background first here on the current recession. It officially started in February. Peak unemployment hit 14.7% in April, and GDP, this is the estimate that came out last week, is now for Q2 expected to decline 46.6%. And just for context, this GDP decline is unprecedented. In the Great Depression, GDP declined 26.7%. So the numbers here are pretty staggering, and I think everybody knows what led up to this in terms of COVID and the stay-at-home orders and the quarantines. So Roseanne and Bob and Howard, how is this one different?
Yeah, so I mean, you're outlining right there some of the ways that it's different. I mean, it is very different. the element of a pandemic introduces a level of personal and social anxiety that goes way beyond economic concerns. And this time we have to think about our health, the health of our staff, the health of those we love. I mean, it's a very different level of concern. The restrictions that on actions that we took for granted in terms of our ability to conduct commerce and interact with each other significantly impedes any efforts that companies are trying to make to reduce the economic impact or capture new opportunities. We can't look to traditional economic indicators to know when this is going to end. We don't know how to predict the behavior of the virus, and in this case, the actions of governmental entities at all levels that can help us return to some normal activity. So I think the level of anxiety and uncertainty in this one is much, much, much higher.
And I think the challenge here is which everybody can see, and everybody participating in this panel is seeing it, is how are you going to do business going forward? I mean, that is a $64,000 question. Is everybody's been at home, and everybody's, I think, for the most part, figured out how to do business remotely. But the question is, as things start to come back, not to normal, but come back, how are you going to do that? I mean, are you going to continue to operate remotely? I've got a couple of investments where the companies are saying, we think we can make this work. And I've pushed back and said, I don't think so. I think, at minimum a hybrid where people come into the office at some, periodically. But I think to go from being a company where everybody's in the office and then, and doing selling and technology and managing and all those kinds of things, and then all of a sudden revert to being a remote business, I think you lose a tremendous amount. I think people are going to have to figure that out. That is a big challenge. How do you run your business going forward? How do you get your customers going forward? Because you're going to do it remotely for the most part. There's very little air travel, all those kinds of things. So I think it's much different and much more challenging.
Yeah, this is tough. Maybe it's always tough when you're in the middle of it and you don't know what the ultimate outcome is. Looking back on the Dotcom and Great Recession, they're behind us. So you sort of a feel there's great uncertainty with this. I mean, is it ending? Are we just starting? Are we in the first inning of the first wave, or is there going to be a second wave? I think what's shocking about it is the speed of the shutdown and the depth of the shutdown. You had neither of those, maybe in the history of the country, where the speed and the depth of it was as severe as this one. And the fact that it affects everybody, every person and every business, every one of our portfolio companies, some more than others, has been affected by this. So I think that's the great difference. And is it worse? It's certainly, the intensity is worse over a short period of time, but let me know where we end up in 6 months, a year, or 18 months, and then I'll tell you how bad it was. It's just, I don't know. I mean, we've got 76 people who haven't been in the office since March 10th. We have our Zoom calls, but how do you close a new deal? I'm impressed, Bob, you nailed one virtually. We're afraid of that. We've closed one investment since March 1, and it was a company we had known for 6 months and met the team and was just sort of wrapping up some things. So I think you're right. There's going to be new ways of working. One of our CEOs, who's had a very centralized view of the world, now is thinking to have more locations, fewer people. And his comment was, this is going to open up my recruiting aperture so much more greatly than before. So I used to think location, do I need to So I think there's a lot of good and bad that can come out of it. Some of us in the old school, the three legends here, may say it's got to be in the office. I think it's going to be some kind of mix that will eventually evolve that'll work for everybody. What that looks like, as Bob said, we have no idea.
I think also this one is going to force changes in industries across the board in terms of how they do what they do, not just individual companies, but you think about the whole system for public health, delivery of public health and access to public health. Major issues like that need to be rethought and restructured that's going to affect current companies, but it's going to open opportunities for others as well.
I
So
do think,
Howard,
go ahead.
no, I'm sorry. Go ahead, Bob.
I do think that the biggest challenge is going to be to the C-level folks, many of whom are C-level people on this call, because I think staying tuned into what's happening inside the company, what's happening with your customers, and I think it's all about communication both ways. Making sure that people know that you understand their issues, whether they're customers or employees, and you're trying to work with them and trying to sympathize with them and trying to help them. And then you've got to build confidence that way in both your customers and your employees that you are on top of it. This is not a time to be a distant C-level CEO type person.
No, exactly right. And look, I think one of the things that people are underestimating in looking at this issue of how do we work is when you're in an environment where you're sort of together a lot and seeing each other a lot, there's so much spontaneity and good ideas that come out of that you don't program. You can't say, let's have a meeting. It's just somebody walking into your office and having a dialogue that wouldn't otherwise occur. And that, for me anyway, as a guy who's been around a while and talked to a lot of people in my firm every day, it's that I'm missing. And I don't know, and I think we're losing out as a firm. And so we have to deal with that. We're trying to communicate better and better. We're having firm-wide meetings. We're doing all the things you should do, but it's harder.
It is. Interestingly, Bob, you and Howard both mentioned remote work, and so we've done we did a webinar previously on how to run a virtual company, and the interesting thing from a management perspective is, Howard, exactly right. It does open the aperture in terms of recruiting, right? And the other thing is that it creates it has created greater inclusiveness for those folks who used to be the one or two that were always the remote guys, right? So now they're not the redheaded stepchildren anymore, if you will. My apologies to anybody who's a redheaded stepchild. But now there's a greater sense of an inclusiveness for those folks who are remote, which is interesting.
Yeah, that's a good point. Yep.
So let's talk a little bit about the portfolio companies that you all are working with. How are they reacting to the recession? How are they reacting to the shutdowns and the work at home environments?
Yeah, so we're seeing our companies being very nimble. They're flexing, they're conserving cash for sure. Some unfortunately have had to lay off staff as they're cutting costs. We're also seeing, though, companies connecting, and we're helping to facilitate connecting with each other to shift staff. So in cases where a company is laying off folks, but another company is actually scaling up, we're sharing staff, we're shifting staff over so that we're not losing that talent and there's opportunities for them. If they're raising capital, as was said earlier, they are pitching virtually and trying to find ways to grab the attention of investors and folks that they want to sell into. We are seeing our companies take advantage of public funds where they're available, a lot more at the local and state level where they're a little bit easier to access and simpler. And then finally, we see companies pivoting and attempting to redirect their products and services to address the new needs that the pandemic is creating and reaching out to government and corporations about their solutions. So we're seeing some doing extremely well and some pulling in, and some unfortunately are going to have problems.
Roseanne's exactly right. But I mean, it affects companies in different degrees. We have a company that helps pharma and life sciences companies do their clinical trials. They're doing great. They just had a record second quarter. There's an even greater need for trials. They know how to handle trials virtually to some extent. So there's a healthcare company that's doing great. But the offset is, we have two businesses between 100 and 200 million in revenue. One, an ophthalmology business in the southeastern part of the country, and one a dermatology business with 55 clinics in New York Metro. Both are, one will do 120, would have done 120 million, one would have done 170. Both were 100% shut down, in March. And how do you go from that kind of revenue budget? Those are budgeted numbers for 2020. How do you go from that to zero, or maybe a little bit of telehealth? So every team has had to react differently to the situation, but almost uniformly, we've seen, rifts and furloughs, and no bonuses are being planned. One of our CEOs who's running a $700 million business took his salary to zero. And we didn't ask him to, we just took it to zero. But many teams are doing deferrals and cuts. 401k matches are being suspended for the moment. Non-essential expenses are being kicked out. There's very little travel, obviously. So it's hit everybody, but in different degrees.
Right. Interesting. PPP and other federal stimulus programs. Were any of your organizations able to access PPP or other federal stimulus funds, and are there any pitfalls that companies should be aware or thinking about with regards to this?
Well, as I mentioned, some of our companies did for sure, and also accessed some of the various counties here in the Southeast launched their own programs, support programs. We launched with the state, Save Our Startups. So we launched a special program for the companies in our portfolio that made it very easy for them to access that support. In any of these programs, the company has to look very carefully at the rules and regulations. Everybody knows with PPP, that's a moving target. So it's important to have the counsel and advice of people who are following this minute by minute to understand what you should do, what you can do, and how to best account for your expenses so that if you're looking for a conversion to a grant at some point, you're well positioned to do that.
Every company that I've got an investment in has been successful in getting that money. But as Roseanne said, it's the next step, because they keep changing the rules, which is interesting unto itself. And to me, to be on the cynical side of me, says this is going to be the full employment act for both lawyers and accountants, because government's going to come in. They're going to arbitrarily pick companies to examine. They're going to find problems, and I think it's just a real issue to be faced.
Yeah, I would just add, for us, it's had limited impact because these attribution's not the right word, but the rules of accumulating your businesses in private equity. You get over 500 people, we don't qualify. So where we've been a minority interest, we've had a little bit. There's a reimbursement, and it's automatic, I think, as it relates to Medicare payments. The government goes into the Medicare payment system, and if you've received X dollars over the last 12 months, you get money. We've got a couple companies benefit from that, but for us, it's more limited.
Okay, interesting. So we back to the poll. We've had a bunch of folks ask questions and respond to the poll. So hey, Danielle, there we go. So here's some of the challenges that folks have asked. So we've got pricing, raising capital, new sales opportunities and pipeline, financial impact on customers. So a lot of great questions. Howard and Bob and Roseanne, do you want to respond to any of these in particular?
Yeah, well, I can respond to the one that asks, is Ben Franklin still investing? And unequivocally, the answer to that is yes, we are. So we are seeing new companies. We do have a sense of prioritizing for our current companies in the portfolio, but absolutely, both through Go Philly, the fund that was that we closed in February, and in our regular resources, we are investing. Also, angels are out there investing. I work with Broad Street Angels, and they're investing actively and have been meeting and have not missed a meeting. So there is capital out there, and folks should pursue it.
Yeah, and I think Bob made the point too. Roseanne and Bob are right on the money here. There's so much liquidity in the market. You know, Bob's got all his buddies and other networks that can put money into companies. Roseanne's quite flush. You know, we're flush. Private equity is incredibly flush. Private equity has so much dry powder that's waiting to be invested. They got to put it out. So the liquidity's there, and you can raise capital in this environment. Absolutely. There may be some obstacles, virtual or not, and all that, but it's definitely available. I think there were some very good questions early on there, Alan, if we can go back, like, you know, pricing. And I'll tell you this, you know, we have a lot of companies in the software industry, whether it's a license model or a SaaS model, subscription model. A lot of customers have come back on their maintenance or their subscription and say, look, I love what you're doing for me, but I can't pay, you know, every month or every quarter. So we've had to give some reductions. You know, we try to exchange the reduction for a longer term, perhaps on the contract. So there's a lot of issues with respect to perpetuating that revenue stream. And again, if you're selling into industries that are particularly impacted, you're going to have a worse outcome. We have a company that sells software into oil and gas. 80% of its revenues is oil and gas. A third of their customer base has come back for, you know, major reductions on the future maintenance stream. So it really depends on the industry. One thing we've noticed, and hopefully it gets better over time, on purchase, you know, new sales, new bookings, purchaser, the whole purchasing dynamic, the whole purchasing decision got significantly slowed, you know, as COVID hit. So many of our companies had a tough time rallying from a tough, you know, in the software industry, the last couple of weeks were very important of any quarter. There weren't a lot of purchasing decisions being made, even by big corporate America, because they were just, everyone was frozen.
Right.
So that's slowed down. So you got a lot of headwinds there, which are overcomable.
I think that feeds into one of the really significant issues in terms of raising money, because when you go out, as you all know, investors expect a set of projections, and there's a set of assumptions behind those, and there's also valuation. So I think presenting a set of projections which take into account everything we've talked about here, and it's all iffy, and maybe you present two cases. You present sort of this is the case as we sit here today, we think we might be able to do, and here's the upside case. So you're not totally, you know, hanging crepe, so to speak. But I think your credibility is going to be affected by not going in with some, you know, extraordinary set of projections, assuming that this is all going to be over halfway through next year, and the next couple of years we're going to be back to growing the way we grew. I think that's very unrealistic and affects your credibility. And then the second issue is going to be valuation. I mean, I can't tell you the number of conversations with people that we're talking about investing in right now. Discussion about valuation, you know, are they realistic? And I think as responsible investors, it's not fair or appropriate for us to crush them. But on the other hand, there are things called down rounds. And I think one has to expect there are going to be some down rounds in this environment.
You know, for an
Let me
existing company, Alan, let's
Yeah, so that is,
for an existing company,
Go ahead, Howard.
you know, it's not, and there's some great opportunities today in the marketplace. If you need talent, there's a lot of talent that, you know, may be wondering, why am I staying at this company? Maybe you can grab some talent. And, you know, we live and die by these buy and build strategies, these tuck-in acquisitions. Great time to find companies that are a lot smaller than our company, let's say, that are really struggling. And you can give everybody a home at a very nominal purchase price. Now I'm talking about companies between 2 and 5 million that you can tuck into your $40 million platform. There's opportunities out there that I think these will continue to materialize as these companies struggle with their debt and lack of equity capital. Companies.
So Howard, I won't let my companies talk to you then.
No, well.
No. So here's an
evaluation is very difficult. People still remember pre-COVID. There's so much capital out there that it tends to sustain valuations. The one investment we did since March 1, we made some, improvements around the edges, but it was fundamentally the same valuation.
So there's an interesting question. So it's been the decline in the stock market was really rapid, but the ascent has been rapid as well. So you've got an interesting situation where certainly leverage has come way down and pricing has gone way up, and underwriting thresholds are tougher. But when people look at the public markets, like the SaaS markets are back at an all-time high. And so when you think about valuation, how are you guiding folks as an investor? How are you guiding folks when they are looking at the SaaS multiples saying, well, wait a second, they haven't moved since pre-COVID?
Yeah, that's a tough one, Alan. I mean, we have not pulled the trigger other than this one sort of legacy opportunity. And I don't know what the future holds. The market is always a good indicator of the future, but I don't think it's comprehended what second quarters are going to look like. I just don't know. And when you have uncertainty like that, you tend to be hesitant about pulling the trigger or hesitant supporting a big value. But that said, there's so much money out there. I mean, we pulled a company off the market in a nice space where 2 private equity funds and a corporate player wanted to buy this company for X. And we just thought it was about 70% of what we thought it was worth pre-COVID. And we just said, we probably did what Bob said we shouldn't do. We said, no, we're not selling it at that price. It's a good company. We're going to manage it. And we've done okay. And that was in March. We pulled it, so it's been 4 months later or 4 months later. And 2 of those 3 buyers at that time, back in February, March, have now come back and said, look, we want to revisit this thing. We probably nicked you on value too much. Let's revisit it. So they're propping up the old pre-COVID values. Why? Because they have, one of them has billions of dollars sitting in a private equity fund, and one is a $20 billion market cap company that says, okay, I got to get back on the M&A side. So you have that, angst there between valuation and liquidity. So we'll let Bob and Roseanne will figure that out.
All right, good. So we're going to move to Q&A now. And if you have questions for the panelists, you can enter them. There's a Q&A window at the bottom of your screen, so you can enter your Q&A questions there. But as we wait for questions to come in, a question for the panelists is, any predictions for how this is going to play out? Any sense for what kind of recovery we're looking at? How are you all thinking, and how are your portfolio companies thinking about this coming year?
Yeah, I'll give you my 2 cents. First of all, most of our companies, we went through a deep dive with all 41 of our companies, and in late March, and we had an investment committee meeting that spanned 2 days to go over all 41. And every company pretty much followed this pattern, rightly or wrongly, because what the hell did we know back in March 30th? We don't know anything more today. We said, okay, so the second quarter is going to be a disaster. The third quarter is going to be better than the second quarter, but the third and fourth quarter won't be anywhere near what we budgeted for the third and fourth quarter. And then 2021 will resume some growth, but over a much lower denominator, because everything will be compressed in 2020. But we have no idea. What has happened for many of our companies is that those 2 healthcare businesses, the eye guys and the dermatology guys, they opened up sooner than we thought, and they're at full boat. Well, the throughputs aren't as great, but they're at full boat. Some of our payment processing businesses that sold to beauty salons, we have one that sells to beauty salons, has come back much higher than our downside scenario. But I don't trust any of this because I have no idea. And the big overlay of over all this is the political overlay. You know, is there going to be an impact? There will be an impact of something in the November election. And what will that, how will that play out? And does that cause everybody to be cautious for a while? So, I mean, I'll defer to my two panel members, but I have no idea.
Yeah.
how-
No, I would agree. I mean, I don't know how anybody can make a prediction. You can just make your best guess and take the steps that you need to with your company. But, you know, recovery is going to be a factor of the level of government and individuals' willingness to take a risk vis-a-vis COVID, and our collective ability to really adapt to a new reality and the pace at which individuals have access to treatment and vaccines going forward. I have no answers. I've got a lot of questions that I think about in terms of what's going to be the shape of capital availability, what's the shape of the venture capital market itself. Is that going to change? Do we have to, is there going to be a need to create new financial tools to support companies who may have a different growth trajectory than the one that we're used to seeing? After the Great Recession, we saw a market increase in government regulation on the financial services industry. I would bet that you're going to see more regulation coming out of COVID, and which industries and activities is that going to affect? We're seeing serious supply chain disruptions. What's going to be the impact of calls to correct that? I think it's going to have international ramifications, which means the strategies of our companies that are going global have to be rethought. We're already seeing companies that are reshoring assets and capabilities, and is that going to accelerate? The pandemic has unleashed unprecedented levels already of federal funding. What's the impact that's going to have on our national ability to sustain that debt, and how's it going to impact our economies and, you know, in our future? At local and state level, budgets are decimated. So what does that mean in terms of the availability of services, especially those who are being hit the hardest? And so what does that mean for where your company sits today? So a lot of questions, not a lot of answers, unfortunately.
I think one of the practical impacts of what both Howard and Roseanne just talked about is that you really, the leadership of the company really needs to be paying attention every day to what's happening in the marketplace with their customers, and then adopt as that experience plays through with all those issues. And some of those things will be better than we thought, as Howard talked about one example, and some will be worse. But the only way that you're going to survive this, so the companies are going to survive this, if you are paying complete attention, talking to your customers, talking to your salespeople, you know, everybody who knows something about the business, talking about supply chain, all those people, and then adjusting on literally a monthly basis as to what your experience is, because you're not going to be able to predict, as everybody says. So figuring out how to be facile and adapt quickly is going to be key to success.
Great. A question that came in, how will this impact your environmental, social, and governance strategy? It certainly seems like it's highlighted the importance of ESG data in company analysis.
Yeah, so I mean, my view is that I think investors are going to be asking for, you know, we talk about what's the impact beyond the innovation. We have been talking about that for years, and I think we're seeing more of a move to focus on companies that are attempting to solve real problems. And I think there will be probably a call for companies that are solving real problems for a while, at least, and less of support for companies that are sort of fun. So I think that is going to see more attention, not less attention.
As Roseanne knows, I work closely with a local family office that's very interested in all these issues, and particularly in diversity. And I think that has become, and Ben Franklin is talking about this at great length, and I think that's going to become an additional part of what everybody does, is what's your diversity program? Is it effective? Is it practical? Is it real? Are you just paying lip service to it? And I think that more and more people are going to say, I'm not putting money in that company unless they have a real and effective diversity program.
Yeah, I'll just second all those thoughts. I mean, diversity, equity, and inclusion are must-discuss topics. Most of our companies on their own have had discussions with their people. We have one CEO who's now on his 4th Zoom call with his employee base, drawing people out of the employee base. It's 2,800 people. He's drawing people out of color and getting them all to talk about their experiences with the entire employee base. So our firm is doing a lot more real time on these issues. So, we're raising our next fund, and every LP wants to know what we're doing with ESG, both as what our feelings are, and then how we're implementing ESG into our diligence, into the ongoing governance of the company.
So another question, and we may only have time for this one last one. And this is a question from an angel investor. So what should an angel investor be looking for in this economy, and any guidance on what should any guidance on investment strategies or where there might be opportunities for investment in today's environment?
Well, first I'll start with management. I mean, it's so basic, and you'll all sort of laugh probably, but as some of the people here, particularly Roseanne and Howard, know, I am not a technology person, and yet I've made a living in the past 25 years investing in technology companies. And it's because I have enough experience in evaluating management and their ability to be good entrepreneurs, understand strategy, understand operations. But it is so critical now. And I have to admit that I'm rethinking the issue. I've made some investments in the last couple of years in a couple of companies that have brand new entrepreneurs, and not to take them out of the mix, but I got to tell you, I think investing in a first-time entrepreneur right now just raises the risk even further than it is otherwise.
So, I mean, we've seen in most of the companies, a lot of the companies that we invest in are so early. Some they're pre-revenue. We're talking about proof of concept investments and really startup or early stage funding. In many cases, the company that we invested in and the company that ends up being fine with us bears no resemblance. I mean, what they started out to be and what they ended up doing, it changes. And so it comes back to, again, management and the ability to pivot and drop what's not working and pick up what something might be more productive for you. So somebody talked about the ability to be facile and flexible and really continue to scan your periphery and your environment all the time. Really, really critical. So it comes down to management and the management team.
Great, thank you. Well, that's about it. It's been a pretty fast hour. We certainly appreciate everybody. Let me turn everybody's participation, and definitely our panelists. Let me kick it back to Dean to wrap up.
Alan, thanks so much. And Roseanne, Bob, and Howard, just such insightful comments. I love the conversation, the back and forth. I could listen to it for hours, candidly. And particularly your last comments around ESG, but also diversity, equity, inclusion, and a real focus on elevating equity in our community and in the technology community. We had an incredible group of participants here today, several Enterprise Award winners and finalists, a fellow legend in the case of John Martinson, and a PACT founding board member, Fairmount partner Charles Robbins. So you had an esteemed group of individuals that you all, as legends yourself, were speaking to. Again, I remind everyone, we will be producing the Enterprise Awards on September 9th. I want to thank Bob, Roseanne, and Howard, as well as Alan once again. Please be on the lookout for the survey to help us improve these programs. Again, thank you to Fairmount Partners for their support, both of PACT overall in this program, and I wish everyone a great rest of your day and a terrific holiday weekend. Thank you.
Thank you all. Roseanne and Bob, great working with you.
Thank you all.
Bye-bye.
Thank you.